Financial reporting standards are generally developed by standard-setting bodies such as the International Accounting Standards Board, or in the U.S., the Financial Accounting and Standards Board, FASB. These are private organizations. They're staffed by accountants, academics, and others. And the financial accounting standard setting process is actually quite lengthy. There will usually be a working committee that will sort of develop a pronouncement or principle. It'll be open to public comment. And typically the implementation, once a standard is even set, usually stretches over a number of years to give firms time to put into place procedures to capture the data or formulate reporting to address that particular pronouncement. Regulatory bodies such as the International Organizations of Securities Commission and the U.S. Securities and Exchange Commission, the SEC, enforce these rules promulgated by those standard-setting boards, particularly with publicly traded companies. Now, with the globalization of our economy, we have many investors in one company that are investing in companies in another company, increased trade where loans might be made across borders. There's been a heightened demand for an international accounting standard. And the IASB, which we mentioned earlier, develops these international accounting standards. And earlier they were titled International Accounting Standards, and are now titled International Financial Reporting Standards, or more commonly you'll see the abbreviation IFRS. The IASB has 4 general goals. The first is to develop high quality and understandable and enforceable standards across the globe so that standards in the United States can be comparable to standards, say, in India. Statements can be compared across borders. And then promote the rigorous application of those standards. One problem that the accountants have encountered as we've come to be a more global world is standards would differ quite a bit between different countries. Third, you have to recognize the needs of small and medium-sized entities. While we're all familiar with very global and large companies, a considerable amount of economic activity around the world actually occurs in small and medium-sized companies that may only have 10 or 20 or 50 people. Lastly, the IASB wants to converge all these national standards, so again, you have good comparability between one country's statements and another's. On this slide, we've listed some of the items that are required for U.S. exchange-listed companies. These are required by the SEC. And if you think conceptually, what the SEC wants to happen is that information is disseminated to potential investors and current investors so that they can make informed decisions about their investments. So let's begin at the beginning with number 1 here, securities offering registration statements. When a company wants to issue stock into the public market, there are a number of things it has to disclose and talk about and provide to investors. And those are usually incorporated in these securities offering statements, sometimes called an S1. Then once a company is publicly traded, there are a number of annual forms that have to be filed as well. The 10K for U.S. companies, 40F for Canadian companies, and the 20F for other companies in other parts of the world that trade on U.S. exchanges. Third is the proxy statement. The proxy statement usually is issued annually. It usually has shareholder proposals or things that might go forward. And a proxy also allows someone else to vote your share of stock. Fourth, there are the quarterly forms similar to the annual forms, the 10Q, 6K, that are filed that give quarterly intra-year updates. The Form 8K is for material changes in the company that might occur outside of that regular reporting. So if something significant that would have some bearing on an investor's decision-making process, such as an acquisition or disposal or something like that, those would be disclosed in an 8K. They need to be filed within a certain period of time right after the event happens. The Form 144 is for restricted securities. And Forms 3, 4, and 5 list beneficial changes in the ownership. So let's say a person takes a significant ownership stake in a company, that has to be filed and made publicly aware. Now let's talk a little bit about the international standards. Their framework objectives are a fair presentation of a firm's financial position, financial performance, and cash flows. And these characteristics should be understandability, so the average investor should be able to understand and comprehend those statements. They should be relevant to the decision-making process and contain all the information necessary to make a decision and those items that would be important in making a decision. And reliability, they should have enough integrity that the information presented there can be relied on to make a decision. And lastly, comparability. You should be able to make comparisons between this company and another company, and over time. You should be able to compare this quarter or this period or this year's performance to prior year or prior quarter. So that's the issue of comparability. Now, the IFRS has 5 factors for reliability. They have to have a faithful representation of the economics of the transaction, that it actually represents what happened. It should be neutral. It shouldn't, the financial statement should not take a position one way or another. Substance over form. You really want to get at what the economics, what the actual impact of the transaction is, rather than how it looks. Prudence, the idea that a careful person would view the transaction this way. And completeness, that all the information to make a decision is actually there. Now, International Accounting Standard number 1 encompasses 5 principles. The first, fair presentation of the transaction. What we want here is that the transaction actually represents what happened day to day, what the actual transaction, what the actual economic impact of the transaction is. The second is going concern. Going concern essentially means that the assumption is that the firm will be in business on a continuing basis. And usually it's typically at least over the next year or two. If it's not a going concern, or if there is a concern about it being an ongoing business, that needs to be disclosed. Third, statements should be on an accrual basis and not a cash basis. Revenues need to be recognized when the sale is made. Expenses need to be made when the cost is incurred. Fourth, they should be consistent from one period to another, again, to allow an investor to compare different periods of time to see how the firm is performing. And lastly, materiality. All material items that could affect decision-making should be disclosed on the financial statements separately, not buried within other larger groupings. Now, in contrast to IAS number 1, U.S. GAAP is actually a hodgepodge of FASB pronouncements and U.S. SEC regulations that have been promulgated over many years, dating back to the 20s and 30s. So, for example, there are more than 150 FASB pronouncements that deal with things that have been superseded over time as economics and business practices have changed. Let's talk a few minutes about the various underlying assumptions and principles of U.S. GAAP. The monetary unit assumption is really that financial statements will be transmitted in a monetary unit, such as a dollar or an English pound, not in units of land or number of buildings or something like that. They're going to be transmitted in a financial unit. The going concern assumption we talked about slightly before. Again, the idea is that the firm, as it's presented in its financial statements, will continue to do whatever activity it is engaged in. An economic entity assumption is really the assumption that the unit, the business organization that we're reporting on is separate from its management, customers, and suppliers. It's a freestanding economic unit. The periodic reporting assumption, of course, defines the periods for the reports. Transactions and things are reported that occurred during that period. The conservatism principle, if you think about this principle, an example would be valuing an asset or a transaction at the lower values. If you had some choices to make about what value a transaction could occur at, you would choose the lower value. Revenue recognition principle. Revenue is recognized when it's earned, when the sale occurs, not necessarily when the cash is paid. The matching principle, revenues are going to be matched with costs. So the fact that we may recognize revenue this period, although we have not been paid under the accrual principle, we're also going to recognize the costs that went with making that revenue. So for example, let's say we made a chair and we sold the chair. We'd recognize the revenue from the sale of the chair, and we'd recognize the cost of the wood and materials and labor that went into that chair, even though those bills might not be paid for some time. We want to recognize the costs related to that revenue that we recognized. The cost principle, we are going to recognize assets generally at the price we paid for those assets. Now, there are some exceptions to this rule when we're talking about marketable securities, but generally, when we buy a factory or a piece of machinery, we're going to recognize that piece of machinery at the cost we paid, not necessarily the market value it is at any given time. Consistency principle. We're going to be consistent in our treatment of transactions across time. Again, I mentioned that comparability between periods in the prior slide. We want to be consistent in our application. Doesn't mean we can't change our policies and accounting procedures over time, but when we do, that has to be disclosed to allow investors to make an informed decision. Lastly, the materiality principle. We want to make sure we disclose everything of significance that could have a bearing on an investor's decision. Now, I've mentioned before the international accounting standards and, of course, the financial accounting standards here in the United States, the FASB. In 2002, the Norwalk Agreement agreed to develop the compatible standards and to maintain compatibility once that has been achieved. And then, furthermore, in 2004, both the IASB and the FASB agreed that all significant standards should be developed cooperatively. And this, the whole idea here is that as we move forward into a more global world, and especially given the size of the U.S. economy, that accounting standards here in the United States would begin to conform with the broader overall international accounting standards.